Welcome to the Deep Dive. Today, we're cutting straight to the important stuff from a recent earnings call.
That's right.
We're looking at Mitsubishi UFJ Financial Group, MUFG. Going to unpack their results for the fiscal year ending March 31st, 2025, and, look ahead at their targets.
Yep, the plan is to pull out the key numbers, the strategic signals.
Yeah.
Basically give you the clarity without all the usual noise.
Exactly. Let's unpack this.
Okay, so right off the bat, FY24 headline. Record profit.
Record profits, okay.
Profits attributable to owners of parent hit.
Yeah?
1,062.9 billion yen. That's a record. Yeah. Second year in a row. Sounds great, right?
Record profits are always the big headline, yeah. But like you always find, the story behind that number is, well, it's usually more interesting.
Definitely.
Gross profits, for instance. They were up year on year, you said, but only marginally. How does that lead to record net profit?
Right. That's really the core of the FY24 story. You had good underlying performance, solid stuff. Well, net interest income, NII. That's, the bread and butter lending profit. That saw a steady increase, helped by yen rate hikes, of course. Mm-hmm. And fee income was strong, too. Wealth management, M&A in Asia, currency impact helped. Mm-hmm. Pretty broad-based.
Okay, solid core performance. But that marginal gross profit increase.
Yeah. Here's where the portfolio strategy kicks in. Big time.
Okay, lay it out for us.
They did a really significant rebalance of their bond portfolio.
Right.
And this meant realizing substantial net losses on debt securities. We're talking around 780 billion yen.
Wow. Okay. That's a big number to realize as a loss. Was that planned?
Oh, yeah. Totally planned. Strategic move. Part of it was to get rid of these negative carry positions. Basically, bonds costing more to fund than they earned.
Okay, so they deliberately took that massive hit on the bond side. But how did they offset 780 billion yen and still end up with only a tiny gross profit increase, let alone record net profit?
Exactly. That's the clever part, or maybe the balancing act. They strategically used gains from selling equity holdings. They've been reducing those cross-share holdings.
Right, slowly unwinding those.
And critically, they reversed a large chunk of previously booked credit costs. This was on a bank non-consolidated basis, so at the parent bank level.
Meaning provisions they'd set aside for potential loan losses, they just released them back.
Pretty much. They decided they weren't needed anymore, booked it as income. So those two things, equity sales, credit cost reversals, they largely offset those huge bond losses.
Okay. So the total gross profit barely moved, but the underlying profit from actual banking and fees, that was growing decently.
You got it. That's the key takeaway on gross profit.
Okay, that makes sense of the profit side. What about costs? G&A expenses, general and administrative, they were up. But didn't management also talk about successful cost control? Seems like a contradiction.
It does sound like one, yeah. But again, it's about looking beneath the surface. G&A expenses did increase by over 339 billion yen.
Why was that?
A few things. Integrating acquisitions, like Kuni, investing in growth areas, and just, inflation pushing things up generally.
So the expense ratio must have gone up then, expenses relative to profit.
Well, yes, the headline expense ratio did go up, but, and this is management's point, that was mainly because the gross profit figure itself was pushed down by those one-off bond losses.
Okay. The denominator was artificially low.
Exactly. So if you strip out the impact of that bond portfolio rebalance, their expense ratio actually improved year on year.
Interesting. So in the core business, they were managing costs effectively relative to the underlying income growth.
That's the signal, yes. Successful control in the operating business.
So another case where the headline figure is skewed by those portfolio actions and net operating profit. Does that follow the same pattern?
Precisely. The stated net operating profit was down year on year by over 250 billion yen. Again, absorbing those bond losses.
Yeah.
But if you take out that impact, net operating profit actually saw a significant increase, up almost 327.4 billion yen year on year.
Okay, reinforces that message again. Core business doing well.
Yep. Robust performance underneath it all.
What about credit costs? Money set aside for loan losses, you mentioned those were down significantly overall.
Yeah, down by almost 390 billion yen year on year. And the main reason was that big reversal of credit costs at the parent bank level we talked about.
Suggests they felt more comfortable about credit quality there.
Seems like it. Allowing them to release those provisions. It's worth flagging, though. Credit costs did go up at their overseas subsidiaries.
Oh, why was that?
Partly business expansion from acquisitions, but also acknowledging, economic slowdowns in some regions.
So not necessarily a surprise.
Management said it was within their expectations. So they seem to have factored in some global slowing, They also mentioned including estimated impacts from recent trade policy changes in their FY24 credit cost numbers.
Okay, let's filter this down. How did the different business groups perform individually?
Well, the bond rebalance hit the global market segment directly. Their reported profit decreased because they booked those losses there.
Makes sense.
But if you look at the customer-facing parts, retail, corporate banking, investment banking, all those core groups saw steady increases in net operating profits.
Driven by
that NII growth from loans and deposits and the better fee income we discussed earlier.
Were there any other sort of one-off items hitting specific segments?
Yeah, a few things mentioned, like an impairment charge on the Nico system in retail, some extra provisions for AOM, a goodwill impairment for GCB and AMS.
So kind of like housekeeping items.
That's how management framed them, yeah. Cleaning things up now to pave the way for more recurring profit later.
Got it. Okay, let's pivot to the balance sheet. Loans and asset quality at year-end, how did that look?
Overall loan balance was up, about 4.5 trillion yen. But interestingly, a lot of that was an increase in government loans in Japan.
Not typical business lending then.
No, it was more of a strategic shift. They moved funds out of short-term Japanese government bonds, JGBs, into these government loans. It's part of their ALM, asset liability management.
Matching assets and liabilities.
Exactly. Managing risk. So moving from short JGBs to government loans was basically an ALM tactic.
What about overseas loans?
Actually, overseas loan balances decreased.
Oh, pulling back.
Management was clear.
Yeah.
It wasn't a lack of opportunity. It was a deliberate focus on profitability and optimizing risk-weighted assets rather than just, chasing size.
And is that focus working?
Seems so. They highlighted expanding lending spreads, both at home and overseas, meaning they're making a better profit margin on the loans they are keeping or making.
Okay. And asset quality overall, NPLs.
Showed improvement. The non-performing loan balance in Europe and the U.S. actually decreased after ticking up the year before. So the overall NPL ratio declined. Looks healthier.
Good. What about their investment securities, equities and bonds?
On the equity side, those unrealized gains on domestic stocks, they decreased.
Why is that? Market drop or selling?
Both, really. It reflected their progress in selling off those strategic cross-shareholdings. They said about 40% sold by cost, agreements for over 70%, and some impact from stock price changes year on year.
And the bond holdings after that big rebalance?
Well, the rebalance significantly cut the valuation losses on foreign bonds. That was a big part of the goal.
Okay.
They still have some losses on bonds tied to specific regulations, and they estimated an unrealized loss on domestic bonds, even after hedging, as of late April. But, and they stress this on a net basis, factoring in their hedges, the overall valuation of the bond portfolio is positive.
Right. Hedging is key there. Okay. Capital and shareholder returns, always crucial. Where's the CET1 ratio sitting?
End of March, their common equity tier 1 ratio, CET1, was 10.8%. That's on the fully implemented Basel III basis, excluding unrealized gains on securities.
10.8%. Isn't their target range lower, like 9.5% to 10.5%?
It is. So they're currently above the target range. Main reason, according to management, was a delay in recognizing foreign currency translation reserves. Basically, the yen's depreciation earlier in the year caused a timing lag in how exchange rate effects hit the capital ratio.
A technical timing thing.
Pretty much. They expect the ratio to drift back into the target range by the end of this fiscal year, FY25, as risk-weighted assets grow.
Okay. And are they doing anything about that currency volatility?
Yeah, they mentioned they actually started FX hedging this month specifically to try and reduce that volatility impacting the CET1 ratio going forward. Proactive step.
Good to hear. And the shareholder return policy, dividends, buybacks.
Policy is consistent. Targeted dividend payout of around 40%. Aim for sustainable dividend increases based on profit growth.
And for this year, FY25.
They forecast 70 yen per share annual dividend. That's up 6 yen from last year.
Okay, decent increase. What about buybacks?
They announced a share repurchase plan up to 250 billion yen just for the first half of FY25.
Just the first half. Why not the full year?
Management's rationale was, look, the buyback amount should reflect the higher profit level they're targeting. But given all the macro uncertainty they flagged, they weren't ready to commit to a full year number just yet.
So keeping options open.
Seems like it. They did point out that 250 billion for one half is an increase on the previous run rate. Their prior annual buyback was 400 billion, so 200 billion per half.
Right.
And they crunched the numbers. If they repeated that 250 billion in the second half and they hit their 2 trillion yen profit target, the total payout ratio would be comparable to prior years. Plus, that level of buyback could boost earnings per share by around 2%.
Okay, so a potentially larger buyback overall, but phased. What about governance? Any updates there?
Yeah, they touched on it. Management acknowledged those regulatory orders about the bank securities collaboration issues and also an asset theft incident.
Right, those made headlines.
They did. So apologies were offered, and they reiterated commitment to preventing recurrence, enhancing governance. The usual reassurances.
Okay, let's look forward then. The big picture targets for this current fiscal year, FY25, what are they aiming for?
This is where they get ambitious. The target for profits attributable to owners of parent. A big leap to 2 trillion yen.
2 trillion. Wow.
Yeah. First time ever reaching that level since MUFG was formed. And alongside that, they're targeting a 10% ROE return on equity. That's using the JPX calculation basis standard for Japan.
Hitting 2 trillion yen, that's almost double last year's 1.06 trillion, even with the underlying growth. What's driving that massive jump they expect in FY25?
Two main things. One, continued profit growth in those core customer businesses. And two, crucially, the full year benefit from that bond portfolio rebalance we keep talking about.
So the pain last year becomes gain this year.
Essentially, yes. By taking the losses last year and repositioning, they expect much better accrual interest income from those assets this year. A big boost to Treasury income.
Makes sense. What assumptions are underpinning that 2 trillion target?
They laid out a few key ones. That trade negotiations between major countries progress, sort of okay, and that the global supply chain doesn't get seriously disrupted again.
Standard baseline assumptions, maybe?
Yeah, but they explicitly said if these assumptions change significantly, they would consider reviewing the targets. So there's a built-in caveat.
That brings up the whole guidance approach, especially with global uncertainty. Some banks tried to quantify potential trade policy impacts. The MUFG didn't really do that, did they?
No, they didn't, and they addressed that in the Q&A. Management's view is, well, these changing trade policies, they could create both upside and downside for the business.
Hard to predict the net effect.
Exactly. They said they assessed the impact on financial markets rates, FX, stocks, but they didn't feel confident drawing firm conclusions about the broader hit or boost to their actual business lines and customers.
So how did they describe their target then?
They called the 2 trillion yen target the most likely and also aggressive plan based on current assumptions. It signals, cautious optimism, but acknowledging the high unpredictability.
Okay. Looking beyond just FY25, medium to long term, what's the vision for profitability?
They're sticking with the policy of increasing ROE. And since they hit their previous 9-10% target range in FY24,
right,
they've set a new higher target, approximately 12% ROE, again on that JPX basis.
12%, that's getting up there.
It is. They framed it as aiming to be a global top-tier financial group in profitability terms.
How realistic is 12%? Did they talk about what it takes to get there?
Yeah, they touched on it. Management acknowledged that getting to 12% ROE might require a shift in their risk appetite down the line, potentially needing to operate outside their current 9.5-10.5% CET1 target range eventually.
So maybe take on more risk for more return.
That's the implication for the longer term. But they were quick to clarify. For the current medium-term plan, they are sticking to the existing CET1 range. And given the uncertainty, they actually aim to start the fiscal year above the range.
Okay, so higher ROE target, but caution on capital for now. How much are they really emphasizing this macro and trade policy uncertainty?
It's a major theme. They explicitly flagged high uncertainty from changing trade policies. They've even set up a specific cross-functional team inside the bank just to assess potential negative impacts on the economy, markets, their customers.
That sounds pretty serious.
It suggests they're taking it very seriously. And this level of uncertainty, they said, is why it's just too difficult to give a confident outlook for FY26 right now, hence delaying specific targets for that year.
Got it. And back to the Treasury strategy quickly, apart from the bond rebalance fixing negative carry, which should boost income by 100 billion yen this year. Any other moves?
They mentioned being cautious about loading up on long-term JGBs.
Even with potential rate hikes coming.
Yeah, they cited a lack of clear visibility on interest rates, despite acknowledging future hikes are likely. So a watchful waiting approach there, it seems.
Okay. Any specific geographic strategy mentions? M&A. India came up in the Q&A, didn't it?
Yes, it did, yeah.
Yeah.
India was mentioned. Management confirmed they've looked at various studies, potential opportunities there. But they said local regulations make big moves difficult right now.
And Yes Bank specifically.
On Yes Bank, the quote was, they are not moving ahead with any negotiations at this time. So sounds like they're exploring options in India, but facing practical hurdles. Nothing imminent.
Okay, interesting nuance. Right, let's shift gears. Time for our This Is Not Financial Advices segment, purely a thought experiment. Pitch us a speculative idea based on this call, hedge fund style.
All right. So based on what we heard, management flagged two things clearly. Lots of uncertainty from trade and global slowdowns, right?
Yep.
And they took proactive steps, starting FX hedging and noting that overseas credit cost rises were, importantly, within expectations.
Right. They weren't caught off guard by slightly worse overseas loan quality, and they're managing currency risk now. Key points.
Exactly. So here's a speculative thought, maybe a pair trade. Betting on MUFG's relative performance against a peer bank.
Okay, long MUFG, short.
Short a peer bank that you think might be less hedged against FX swings, or maybe has more concentrated exposure to specific emerging market credit risks that could get hit harder by these trade policy shifts.
So the logic is MUFG has acknowledged the overseas credit risk within its plans and is actively hedging FX now. This might make them relatively more resilient if things get choppy with currencies or credit linked to trade disputes, potentially outperforming a less prepared competitor?
Precisely. It's a bet on relative resilience, playing off the specific risks and actions MUFG management highlighted themselves. Pure speculation, obviously, not advice.
Fascinating idea, though, purely as an intellectual exercise, of course.
Of course.
Okay, so let's pull back and summarize the key takeaways from this MUFG deep dive. Record profits in FY24, yes, but achieved through that significant bond portfolio rebalance, offset by equity sales and credit reversals.
Balancing act.
Then, a really ambitious 2 trillion yen profit target for FY25, driven by core business strength continuing, plus the big tailwind from that bond rebalance finally paying off on the income line.
Big target.
Commitment to shareholder returns is strong higher dividend forecast, significant buyback announced for the first half with potential for more.
Yep. Returning capital.
And they're navigating this backdrop of major macro uncertainty, especially around trade policy, managing risk carefully, starting FX hedges, while also setting sights higher long term with that new 12% ROE target.
That sums it up pretty well. And again, just our analysis of the call-in, folks.
Yes.
Definitely not investment advice.
Absolutely. So to leave you, our listener, with a final thought to chew on, think about that new 12% medium-term ROE target. Management hinted that achieving it might eventually require a change in risk appetite, maybe pushing beyond their current capital range. Given all the global uncertainty they themselves highlighted, what kinds of strategic risks or maybe investments might a giant bank like MUFG need to take to actually hit that higher return? And how might the macro picture, trade wars, inflation rates influence when and how they decide to potentially step on the gas? Something to mull over as you watch them navigate the path ahead.